In this video, I'm going to walk you through an example of an income statement. Now, the example that we're going to go through is kind of lengthy, just to illustrate all the different kinds of things that might show up in an income statement. But bear in mind that an income statement is basically, at its heart, it's revenue minus expenses will yield net income. That's all it is. And the thing is, there's a lot of different things that can go into revenue or go into expenses, and we're going to break them out in a more detailed format. So let's scroll down here. So the most important thing to note at the start is the heading. So remember that the income statement is for a particular period in time, kind of the results of the firm's operations. So we see for the year ended is what we have. So we're looking at the results of the firm's operations for a year. And then the numbers, which can be kind of large for some firms, they're typically just in millions or in thousands or something like that. So this number is not just saying that the firm had $1,000 sales. You can actually go on and add on. So this is like saying 1,000 million or something like that. So if this was in thousands, then this would be a million, but given it's in millions, it's actually a billion. So this firm had $1 billion in sales. And what we're going to notice is that when we start with this sales figure, we don't just leave it at that. We've got to make some adjustments here. Okay, so we want to get to a net sales, and we do that by looking at, okay, well, did we have any sales discounts during the year? Did we have any sales returns or allowances? We have to net those things out. If we discounted some of our sales, well, then we didn't get as much in sales. Now, you might think, well, why do we even care about these things here? Why didn't we just originally record 978 in sales? Well, the reason we might want to do that is we can separately track these. We might say, okay, well, you know what? We're giving a lot more discounts than what we thought or something like that. So it's useful to kind of break things out. So ultimately, we start with this sales number, and then we get to the net sales after making some of those adjustments. So the next thing we're going to notice is the cost of goods sold. Now, for some firms, if it's a service-oriented firm and they don't really have a product that they're selling, you might not have a cost of goods sold. This isn't always going to be there. Or you might have something called cost of revenue. So in any case, when you do have the cost of goods sold, what you lead to next is the gross margin. So gross margin is a subtotal. So this isn't something that's actually being deducted or added to this sales figure that we have here. We're starting with the sales, we're netting it down, and then we're getting to we're taking out the cost of goods sold, and this is like, it's kind of just a subtotal. This is just a subtotal. Now this subtotal is very useful, and I've done some other videos on why the gross margin is important. You know, we have a lot of other things we're going to deduct, but this can kind of give us a picture of how good are we at selling things after we've marked them up. Right, so we make some kind of we purchase $350 worth of goods, and then we go ahead and we apply some kind of markup. We sell it for more than we make, and this gross margin tells us how good are we at doing that before we think about legal fees, or before we think about how much we're paying our CEO and so forth. So it's a nice subtotal, and it's useful. But now we're going to get into operating expenses, and operating expenses. Well, there's two parts. There's selling and general and administrative. And I'll just start with this selling component here. Now, when we think of sales expenses, we can kind of break it out in a lot of different ways. But one thing we might see commonly is commissions. So if you pay your salespeople based on commissions, well, then when you make sales, you're going to have to pay them. You're going to incur an expense. So we've got the sales commissions. We also have potentially advertising expense. So of course, it depends on the firm. Some firms might not advertise at all, but you might see advertising expense here. And then we're going to have if the firm pays for the shipping rather than the buyers paying for the shipping, then you're going to have this freight out or shipping expense, the expense you incur to get this product to ship it to your customers. And then depreciation. But now when we talk about depreciation here, we're talking about depreciation specifically of sales equipment. So when we get to the next item, for example, general and administrative type activities, we'll have a separate depreciation for administrative things. So when we get to all this, so we've got all these purple numbers here, all these sales expenses come down to here. and we've got a little subtotal, and then that's going to be deducted from our gross margin. But we're not going to do that just yet, because we're going to look now at the administrative component. And then the selling and the administrative component, they're all operating expenses, so we'll just go ahead and deduct those and come to something called operating income. So there's our operating income right there. But let me just go through the administrative briefly. So this 131 here might include something like the salary of the CEO, and then we've got the depreciation, but it's as it pertains to the administrative function. So maybe the building, the office where the administration is, or equipment related to administration, copy machines. And then we've got a legal expense, insurance. These are all kind of administrative expenses, and we ultimately get a subtotal for that. And then we add these two subtotals together and then deduct them from our gross margin to get the operating income. So the reason it's called operating income is because basically when we think of this subtotal here, we're thinking that this is the subtotal of income for the firm's main core operations. This is the bread and butter number here in terms of the firm's main operations of making goods, of selling the goods and paying the administration to kind of oversee this whole process. This is the number that we end up with, this operating income number here. But now we can start thinking about some other things. Like, for example, if we have debt, if we have loans, then we have to finance our operations. And so we might have some interest expense, but also we might be investing some of the cash that we've made in previous periods. So we have to think about interest in terms of net interest. Now, for some firms might have this broken out into kind of like an interest expense, and then they might have another line item for interest revenue, but we're getting to the same place here. So when it's interest net, we're just saying, okay, well, let's just put these two things together. And so, maybe they had a certain amount of interest revenue and a certain amount of interest expense, but when they net it together, they actually had, for this firm, we'll say they had $3 of the actual revenue. So whatever their expense was, it was outweighed by the actual money that they earned in interest. So we have $3 income here. So we're going to actually add that. We're going to add that to this 247, this operating income, and then that's going to yield income before income tax of 250. So now this income tax expense, it's important to note that is not necessarily, that this is not the same number to the actual return, to the actual tax return. There's some number on the tax return. We don't know what the firm's actual tax paid on their tax return is, because we don't have access to that. But we can make some educated guesses. But here we're just going to say, like, okay, well, we just apply, let's say a 30% rate, and we're just going to say, okay, we'll take this generic rate and we'll apply that and say, okay, that would lead to something like 75 in income tax expense. But bear in mind, this is not the exact number from their return. This is not the amount that they paid out necessarily. This is a rough kind of estimate. And so now we get to this income from continuing operations. Now you might say, well, why do we say continuing operations? Well, for all firms we wouldn't necessarily say that, but this particular firm has something called a discontinued operations. Now there's going to be another video where we talk more in depth about discontinued operations, but it's basically when you've sold off a part or segment of your business and it no longer exists. So you get rid of this disposed segment and it's going to go away. So, yeah, and you might not technically have disposed it yet. You might have just made a plan to dispose of it or so forth. There's some things you can qualify for this. But basically you've said, okay, this is no longer going to be a part of our core operations. This is no longer going to be a part of our business going forward. Next year, the year after, this is going to be gone. We sold this segment or we're about to sell them. And so it's been discontinued. So we really think that this should be separated out so that people don't see, that we really want to focus on the continuing operations if we want to make predictions about how the firm's going to do in the future. That this is ancient history. This is going to be gone. But it's still there this past period, so we still need to report it. And so it's in parentheses because it's a negative number. This could be positive, it could be negative, It could be any. So in this case, we're going to say we're going to present it net of tax because we've already done the tax expense here. So we're just going to present this net of tax and say that it's a loss of 16. So we're just going to deduct that from this 175 of continuing operations, and this is going to be discontinued. Now, another thing. Now we technically could have now some other subtotal of income before extraordinary items, but I just put it right here. It's now we have an extraordinary item. So this extraordinary item could be that something. When we say extraordinary, there's a lot of things we talk about here. It could be that there was an earthquake or some kind of infrequent, unusual event that the firm really couldn't have expected, and so they've got this loss of 4 for that, and so then that's going to be deducted as well. And so this is a separate line item. It's not expected that this is something that might recur in the future. And we'll have another video explaining what extraordinary items are, and they're typically presented net of tax as well, just like discontinued operations. Now, bear in mind, not every firm is going to have these things. So if the firm doesn't have them, then they would just go ahead and, instead of income from continuing operations, it'd just skip right down to net income. But in any case, whether you have these things here or not, you eventually get to net income. And net income I've got double underlined here because that is known typically, kind of informally, as the bottom line. This is the bottom line. This is profit. There are lots of types of profit. We got subtotals like operating income or operating profit up here. But kind of the bottom line profit. When we think about how did the firm have a loss, did they make money? Well, we got here 155. They made money. They made a profit. The net income, the bottom line. But in a way, it's not always necessarily the bottom line because we'll sometimes have another number here, which doesn't, it relates. It's net income is usually calculated. When we spread this net income over all the common shares outstanding of this firm, all the shareholders, so let's say you have 1,000 shares outstanding or 2,000, whatever it is. We have all these common shareholders, and we say, well, how can we spread this 155? If we spread it over all these common shareholders, what will we get? Well, when we think about that, we'll just say we'll come up with some number of 50 cents a share, 30 cents a share. Here, I'm just going to say we'll just say $1.31 a share. So typically in an income statement, even though net income is the bottom line informally, we'll end up having something underneath. It might say like earnings per share. So saying if we were to divvy that net income out among all the shareholders, hypothetically, how much would they get per share? So this is an income statement.